Good morning, ladies and gentlemen. Welcome to the Downing Strategic Microcap Investment Trust PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and we'll notify you once these are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Judith McKenzie, Partner and Head of Downing Fund Managers, and Nick Hawthorne, Fund Manager of Downing Strategic Microcap Investment Trust. Good morning.
Good morning. Thanks, Paul. As Paul said, I'm Judith McKenzie and I'm joined with Nick Hawthorne, who you can't see, unfortunately, thanks to good old broadband in Scotland. However, I'm going to crack on with this and I will remain on screen. So what do? Oh gosh, now I need to be able to drive this. Could we maybe move to the next slide, please? There we go, the next slide. So what do? We spend our time doing one thing really, and that's searching and then eventually, after a lot of diligence, investing in and working with small UK companies under 150 million market cap. And firstly, we're looking for fundamentally good companies which are misunderstood and maybe a little bit unloved, and where there might need to be a little bit of change or a catalyst put in place. And we want to be buying these companies at a significant discount to what we think they're worth. And that value might be book value, but more often it's the value of their future cash flows and their earnings. And that's really how we come up with that intrinsic value. And the second thing that we do, which is core to our thesis, is to seek out these catalysts. And you'll hear us talk a lot about catalysts as we go through this presentation. We don't just want to buy cheap companies and hold them forever. We want them to break out of being cheap. And they can really only do that if they have a catalyst for change in place. So when we buy these companies, we're taking and with those catalysts in our pocket to deploy with management teams and get worth for all shareholders. So we go in with a plan and with tangible levers, which we can then pull to get better underlying performance and turn that leads to better performance and ultimately leading to better earnings and cash flows and hopefully a better multiple and share price. And with these catalysts playing out, we're hopefully closing that gap between the value of the company today and what we believe it's actually worth. And the last thing, when we buy this influential stake, taking up to 25% of the equity, sometimes we'll take a board seat, sometimes we use private equity structures like loan notes and preferential returns, and we use our position to influence and facilitate those changes and affect the catalyst that we've identified. And what I've said might sound quite simple, but all these steps, they do take time, and it does tend to be a bit of a J-curve. And as we talk through the trust that where it is today, now it's about 4 years old, you'll see that we're coming through that J-curve with the portfolio that we have and the companies that we've added to it. We do have an investment horizon of between 3 and 7 years. Very important to be a long-term shareholder in these types of companies. We also have a team of 3 fund managers specialising and dedicated to the trust. So to sum that up, we buy good companies which are misunderstood and need some changes made. We look to see how we can implement these changes and catalysts. We make sure we can affect them, and then that's how we make a return for our investors. Just moving on to the next slide. So this graph really says one main thing, and it tells you that the companies in our range under 150 million market cap, that the market is highly inefficient. And that is a bit of a challenge, but it's also the opportunity. So you can see that there are very few analysts covering our companies. MiFID II has definitely exacerbated this. So there's 0.6 of an analyst covering the companies in our universe. You go up that market cap scale, and then you get 4 to 5 analysts covering companies. And therefore, if you only got 0.6 compared to 4 to 5 analysts, then you're definitely going to have an inefficient market. Also, it's driven by a couple of factors. One is because few investors and big houses, big investment houses, can't invest in this space because they'll be trying to get funds to be as large as they can, and therefore if you've got large funds you therefore can't invest in very small companies. We are a boutique fund manager and we're therefore able to do that out of this trust, which is absolutely the right vehicle for it. And of course, we all know that value's been out of favour for quite some time now, and therefore it has been an area of the market that has been overlooked. But I think where we're sitting today, and Nick will talk about some of the macro factors that we're looking at, I think there will be a nice tailwind, and actually will be better favour towards smaller companies and value companies, which really is our style overall. And so therefore, it means it's a really good hunting ground for a diligent investor who's prepared to do the work and search out these catalysts. Nick, I'll pass over to you.
Thanks, Judith. And apologies again, I can't get my video to work this morning. But just looking back at 2020, as we all know by now, 2020 was an exceptional year in many ways, and our companies certainly endured conditions which they never have done before, with complete shutdowns and also phased lockdowns. But overall, we do think that our companies performed as well as could be expected, and in some cases better than could be expected, with all management teams using that downtime to make changes, which would allow them to emerge as much better businesses going forwards. So we've been quite pleased with the performance since COVID. The NAV per share is now comfortably higher than it was than before COVID hit, and we think that shows the hard work over the last 4 years is now beginning to pay off. We've also seen a significant amount of portfolio activity in the last 12 months. We made 6 new investments. 5 of those investments are still in the portfolio today. And we passed an important milestone with our investment in RGD in May this year, where DSM collected over 5 million by the way of its 10% loan note investments being paid back following the disposal of one of the RGD businesses. This takes RGD to below a 10% position in DSM, and it means that cash is back to 20% at a time when our whip list looks as good as it ever has done. And that leads us on to why now. And we do think that just now is a good time to be looking at DSM. As I've just discussed, we've more than halved our exposure to RGD. And this has been a challenging situation for investors and indeed potential investors in DSM to understand. So we think that makes our position there much more clear going forwards. On the back of the new investments made in the last 12 months and the performance in the existing portfolio, DSM is still sitting at over a 40% discount to what we think these underlying companies are worth. And on top of that, investors would be enjoying a discount which has stayed stubbornly wide at over 10%. But we do think there are some catalysts to close these discounts over the next year and into the medium and long term. Not least at a top-down level, as we've all seen, with fears of inflation and potential Bank of England policy to tackle inflation. This has taken the shine off some of the lofty multiples we've seen at the top end of the market. We don't invest in companies on 30 to 40 times earnings. We tend to invest in much shorter dated cash flows. And as we see that sentiment shift back into value investments, we do think that this should be a tailwind for existing holdings. And of course, as Judith mentioned, the most important thing here is the individual company catalysts. And we think that they are as good as they ever have been. With the number of companies in the portfolio, they're still exposed to an economic opening. We see the shares still sitting below the level at where COVID began. So we do view these as easy wins, and they should be bolstered by the ongoing positive momentum in the other companies where we have endured that J-curve over the last 4 years and where we're now coming out of the other side. And finally, we think that one of the best indications of the opportunities in the portfolio is the amount of insider buying of the underlying holdings. And on that basis, we've seen 9 out of 13 holdings having announced management buying significant amount of shares since COVID began. So overall, we think that that bodes well for the future. We think that just now is certainly a good time to be looking at DSM. back to you, Judith.
Thanks, Nick. So this slide's a bit busy, so apologies for that. But when you've only got 13 investments, it does give you the luxury of actually being able to give investors a bit of an insight as to why we've invested in them and actually what we do. If you don't mind indulging me as I canter through some of these positions. And here you'll see that the market cap's everything from, I think, 2.9 million up to sort of 500 or so. And yes, we see that we invest in companies that are under 150 million. That is at the time of the first investment. And we like to try and ride our winners once we've spent the time doing the diligence and getting through the process with them. So I will just give a bit of a snapshot. I won't talk about the first two because they come on in our case studies later on. Adept Technology Group does what it says in the tin, really. It's a telecoms integrator working across UK public and private sectors. And that's an attractive business because, well, it's a sector that's really been consolidating. And it's a management team that have been there, done it before, and very, very good at acquisitions. So we believe that overall sector is probably going to throw out some interesting opportunities. They actually made an acquisition not so long ago. And what we like about this business is that it's got recurring revenue. So the quality of earnings is really good. And it converts quite a lot of its earnings straight into cash. Again, something that's quite attractive. Fire Angel, completely different story. They're a manufacturer and designer of safety critical smoke alarms, CO alarms. So very much in the fore when it comes to regulated markets and obviously the advent of new regulation coming in the back of Grenfell. This is a company that has managed to find a few banana skins on its way through turnaround. We helped put a new exec chair in place about 2 years ago, and really just helping them get to that stage where they can really capitalise on those nice margins that they should get from the sector, and also the growth markets that come through regulation. Hargreaves, completely different. Once again, this is a NAB play to a certain extent. It used to be the largest distributor of coal in the UK. They're now capitalising on a significant land bank just outside Edinburgh predominantly. And in this case, we helped put in a chairman again a couple of years ago, and he's been buying shares alongside some of the other directors, and a good testament to the value that's within that business. Ramsden's a little gem that probably is overlooked to quite an extent. Hasn't really had a great COVID because they've got leaseholds in pawn shops and FX, so they sell FX to the likes of you and me when we're going off on holiday, and of course we've not been going off on a holiday. But this is, again, very heavily sort of asset-backed in terms of cash, and also the jewellery and gold that they hold. And they're an exceptionally good operator, so will definitely be a beneficiary when things open up. Synectic's another little business that's has been underneath the radar for so many years, but when you look at what they do, the safety systems and infrastructure, so everything from your rail and roads right the way through to government installations. So again, a company that probably is quite predominant in the UK market, but nobody really knows much about it. And our job is to shout about it and show people that this company that can generate 3 million, 4 million in cash is sitting on a market cap of £24 million when it's got net cash in the balance sheet as well. Venture Life, one of our newer investments in the last 12 months, they're a bit of a mini Allied pharma, and they acquire and pick up various consumer health brands and then put them through their own distribution. A nice little company that's growing both through acquisition and organically. Flowtech, Nick will talk about in a second. And Digital Box, one that's slightly newer. They own some great little titles that they exploit through their digital platform. Includes The Tab, which is a student magazine, Entertainment Daily, and the Daily Mash, if anybody actually reads that. Very popular listing. I will come on and talk about Tactus, which is one of our newer positions. We don't have a slide in it, but I know there's been a bit of interest on it through the questions. And Duke Royalty is our innovative royalty provider, one of the smaller positions in the portfolio at the moment. And of course, we've got about 20% in cash, but it's not going to be sitting around for too long because we've got a very decent whip list and cash to deploy Nick, do you want to come on and talk about the outlook for this portfolio?
Yep, thanks, Judith. As I explained before, we have seen a lot of insider buying of the underlying holdings since COVID. And fundamentally, we do think that that is one of the best indicators of the opportunity ahead for these businesses. As you'll see on the slides here, in all cases, we think that the outlook for these companies is good and markedly more positive over the next 12 months than it has been for quite some time. As we mentioned before, we have been on a journey with many of the legacy portfolio companies, and that has meant a significant J-curve as changes were implemented. Those changes have taken longer than we expected, but all of the companies, we think, are now in a much better position going forwards, and the individual company outlooks are much more positive. As Judith alluded to there, we will use the case studies to come on to talk about some of these in much more detail. But the newer holdings that I mentioned, we made 5 net new investments. Those would be Flowtech, Tactus, Venture Life, Digital Box, and One Toehold that you see there. All of those positions are performing well and certainly ahead of the expectations that we had at the time of our initial investment. I'll hand back to Judith for the first case study.
Thanks, Nick. So Real Good Food, the one that's been probably the most strategic, I think is probably the best way of putting it, in the portfolio since we made the investment just in June, nearly 4 years ago. So why did we make the investment? Real Good Food was a bit of a food conglomerate. They had 5 different divisions, rather disparate companies that had been, I suppose the best way of putting it, thrown together. And our investment case there was that we believed that the sum of the part, the individual businesses themselves were worth more than the entry value that we were going in at. And we had that understanding as well with the other shareholders, main shareholders that were there. So the plan was to look to try and divest and get value for those underlying companies. Now, it's not been a smooth journey by any means, and we've been through quite a lot of management change, and the board pretty much has changed completely. Aside from my board position, I sit on the board of this, and that was part of our terms and conditions when we made the investment. We made the investment in both equity and loan notes, and we did that because we wanted to try and get some investor rights, and that has actually played out. So the disposal process has been undertaken. There's been roughly £60 million of disposal proceeds coming back into the company since 2018. And the most recent being a disposal of Brighter Foods to the Hut Group within the last 2 or 3 weeks, actually. And that has meant that there's about 5.3 million of cash come back into DSM, 3.7 million of it being in capital, and around about 1.7 in interest and redemption premium. And that equates to roughly an unrealised IRR of about 12%. So slightly underneath our overall, but there's still, we're despite the hard work, we're only really maybe 2/3 of the way through the journey when it comes to valuation here, because the company is left with a nice little business called Renshaw. Renshaw is a manufacturer, distributor of cake decorations, so sugar paste, icings, frostings, and that is quite an attractive market. We've got a dominant share in that market, both in the UK and internationally. So we still have a lot more to play out here, given that there's now only about 20 million of debt left in the PLC. The pension fund has been neutralised, and Renshaw pre-COVID had earnings of, it was going through turnaround of around about £3 million. There's some central costs there. So you can see that the EBITDA can really be anything from sort of 3 to 4 or 4.2, 4.5 million pounds. You start putting a multiple on that, say between 7 and 10 times. Brighter was sold for roughly 10 times. Then you can start seeing that you can generate a potential value of 30 million plus for that business. And we get it right, then it starts throwing off cash as well. So it's a nice asset and a tidied up PLC that we've now generated, and we've had a decent return of capital back and return. So a bit of an example as to how these types of strategic investments can play out. I do emphasise that not all the portfolio is as strategic and hands-on as this this investment. Otherwise, I would have a lot more grey hair than I already have. Nick, do you want to come and talk about the next couple of investment cases?
Yep, thanks, Judith. Our long-term investors in DSM will obviously be well aware of Volex, but I'm just looking at the poll that we got at the beginning of the call, and almost 50% of the call here are not holders. They may not be well up to speed on Volex. So firstly, I should explain what Volex is and what it does. And essentially, the business manufactures and sells power cords and cable assemblies for applications into many sectors, such as consumer goods, data centers, healthcare, medical imaging. We began our diligence on Volex about 18 months before we made our investment in DSM. And that involved meeting management many times in London. We visited one of the cable assembly sites in Poland to meet the management team there, and also get a feel for the value add of that, the cable assembly division. At the time, the business was cheap because it had, before the newest management team who we backed, been poorly managed and had awful fundamentals. And that was due to having been over-focused in highly commoditized power cords and with many years of poor capital investment decisions. But what we saw in Volex was a market leader in terms of scale, certainly in the power cords division, with significant self-help opportunities. And they also had excellent customers and end market exposures. On the back of that, and as I mentioned, there was a new management team, and they had bought 25% of the equity themselves, and they were managing to deliver better margins by focusing on higher value activities and better quality customers. So today, that gets us to a company which has exposure to compelling long-term sectors, as I've just mentioned, such as EV, data center, and healthcare. And importantly, we think that they can earn sustainably good margins by focusing on customers in these spaces. With the DECA acquisition, which was completed earlier this year, they acquired what we think is likely the most efficient and cost competitive consumer power cord facility globally. And we think that's important for a few things, and perhaps that the market hasn't picked up on, but it in-houses exceptional manufacture and supply chain knowledge, which we think could be utilized in some of the wider Volex customers, and that will let them win customers which they could never compete for before, and at good margins. So to date, the shares have performed well for us. They're up over 4 times since we bought them in 2018. But we do think that some of the most exciting developments may still be ahead of the company. If they can continue taking share in the markets that we mentioned, if they can continue on the margin self-help, and particularly on the supply chain side and the manufacturer side, to become best in class and more cost competitive. And if they can continue to acquire, as they have done in the past, cheap businesses which had new customers, skills, or markets, and if they can continue to earn over 30% on invested capital, we think if they can do all of these things, then we don't see why, in the fullness of time, the Volex can't still double earnings again and achieve more multiple upside to date. So if we put all those together, we still think that there's exceptional upside opportunity in Volex, albeit that's going to take longer than the 4 times upside that we've enjoyed in the last few years. And just quickly before I move on, there's been a question on the Q&A here that we've been bullish on Volex, but we've been selling down along the way. And we're keen to highlight that selling down isn't a change in our conviction, but it's purely a function of Volex having become quite a large part of DSM, and it was well over 20% at one point. And we do have to manage our exposures, even allowing for the high conviction that we had. So that's Volex. If I move on to Flowtech, which is one of the newer investments that we made this year in the depths of COVID, actually. Flowtech stocks over 55,000 individual SKUs. These are kind of spares and parts which find their way into essential sectors and also into capital equipment OE.
Yes. Sorry, Nick, we just lost you for a millisecond there. So just to say, just literally, just digital, but I'll put myself back on.
Hi there. Yes, so on Flowtech, they stock over 55,000 SKUs. So these are spares and parts which find their way into essential sectors and also into capital equipment OEMs. The key here that we think is Flowtech's value add service, where they typically supply next day, and that lets them earn the 35% plus margins that we've consistently seen. The other aspect we like is the 60-40 split between maintenance type spend and CapEx type spend, which adds a nice piece of visibility into the model. And finally, the nature of the business itself, which is essentially a stock holding business, where in lean times or when turnover is declining, the business can significantly curtail investment back into working capital, and that helps them manage cash flows. And a nice example of that has been in this 2020 COVID year, where they made an accounting loss, but had over 9 million of positive cash inflow. In terms of the investment journey in Flowtech, we view this in two stages. The first is the business just getting back to similar levels of turnover, which it enjoyed before COVID, but with a much more efficient cost base, with some of the 5 million of cost savings that management have outlined having been implemented. And importantly, we think it will be less cash consumptive going forwards as well, owing to all the hard work that management have done on debtors, payables, and stock. We do think that there are some significant tailwinds in the UK, which can push turnover higher. And of course, that will be on a lower cost base, as I've just mentioned. One of those tailwinds, which we think investors or potential investors haven't picked up on, is in the form of the UK super deduction, which was announced in the 2021 budget for the next 2 years, where companies will save 25p in tax per £1 invested in new capital equipment. This was announced to stimulate business investment post-COVID-19, and we think this should lead to additional investment and a catalyst to pull forward planned expenditure into the next 2 years. We also noted in the annual accounts this year that management are going to be paid a cash bonus for achieving numbers significantly above market expectations for 2021. So we think that there's some nice short-term catalysts here, one of them being conservatively set numbers, which management are well set up to beat. Beyond this, we think that there's likely to be some further M&A in the medium and the long term, as there is a long tail of small businesses which could be consolidated and will deliver significant synergies. When we put all of these elements together, and keen to highlight in the fullness and time and with some excellent execution by an aligned management team, and just on that point, it's worthwhile noting as well that the chairman has just bought over 1% of the equity. But we do think that the business could feasibly move towards a 15 to 20 million pound EBITDA business with a similar sort of multiple, and that particularly if the e-commerce investment pays off. So overall, we think that Flowtech could be at the beginning of quite a similar earnings and multiple expansion journey, which we have just enjoyed with Volex over the last few years.
Thanks, Nick. I'm going to talk about taxes. We don't have a slide for this, but we realised that when the questions were coming through earlier in the week, that you were quite keen to get a bit of a flavour as to what this investment was. So I'll cover it off just now. It's our newest investment. We only completed on it in the last 2 or 3 weeks. It is an unlisted company. It's a private company, and that's quite unusual for us. Obviously, with the loan notes and Real Good Food, they are unlisted. but we haven't actually made our investment in a company that's unlisted yet. Well, I've done in my history, but not within this trust. And so when we set up the trust initially, we were keen to have the flexibility to be able to have 10% in unlisted companies if we so wished. And the reason that you do that is that sometimes when markets get a little bit hot, it is nice to use your deal flow to look at companies that are maybe not quite at the stage of an IPO yet, but at the same time probably have a good prospect. So we made the investment in equity and loan notes, quite unusual for us. Only Real Good Food where we've done that previously, so it's 50-50. And we were quite interested in this little business for a couple of reasons. So tell you what it does first. Taxes, designs, markets and sells IT hardware. And if you can think about budget laptops and notebooks, truly that's the space that they're in. And probably your first reaction is that it's a very competitive space. So you've got obviously the likes of Dell, Lenovo and ASUS even in that space. But in fact, if you go back to November last year, this little company Tactus, flying underneath the radar, was second only to Lenovo in the number of units that it was shipping, and that growth has continued. I would stress that they don't manufacture. They outsource this to third parties, mainly in China, but their real USP is the navigating of that supply chain and also delivering on time, way ahead of some of the larger beasts that are out there, monolithic beasts that are out there, and with very, very relevant products. So they're very, very good at the design aspect. And they had a good COVID year, without exception really, because they delivered a significant contract to the Department of Education, which is still ongoing, but we weren't buying it on the back of those earnings, we're stripping that out. But what that contract did do was put them on the radar of Best Buy in the States and others that are looking for a more nimble and flexible solution. And our money's helped fund a small acquisition, and they're a component seller, but very, very smart at the design of gaming systems. And we also think that actually that will mean that they go into that PC gaming market with their own e-commerce platform. So not just B2B, but then going straight to B2C as well. And most importantly, the management team's got the experience here. Is one of the platforms. It's a 125 million turnover business at the moment, so not insignificant, with good profits. And there really is a clear strategy to double that, and both in turnover and earnings in the shorter term. So it could well be an IPO candidate at some point. And if you look at the peer group multiples on market, we're investing around about a third of those multiples. I won't say too much about our entry price, but we're very happy with where that ended up. So early days yet, private investment, slightly different, but with a relevant structure and a very nice growth profile. So hopefully that gives you a bit of background on why we invested in Tactus. So just to summarise, the trust is trading on a cover off in a second discount to the intrinsic value, where we believe that the true value on a base case assumption should be.
Judith, apologies. I think we're just having a little bit of connectivity issue with you here. You just frozen on us, so bear with us, please. We'll just get you back through. Judith, if you just, that's it, turn your camera off, and if you can just carry on, just switch your microphone on at the top of the screen. Hi there. That's it. That's
Hi.
it. That's better. Thank you, Judith.
We've definitely got the gremlins today, haven't we? So just to finish off, I was saying, hopefully you heard me, maybe not, but if not, for the second time, the 13% discount in terms of the actual share price discount to the NAV, and I'll come on and talk about discount management in a second, and 43% discount to our intrinsic value of these, and that's on a base case of these companies. The exposure to Real Good Food has been reduced, which I think allows people to actually look at the value of that underlying business a bit clearer now. There is a clear board commitment to discount control. Through COVID, the discount did narrow from 30% to circa 13%. We've just come out of a closed period as well, because the results are coming out, and there has been quite an active buyback mechanism. But most importantly, discounts narrow for two reasons, not just buybacks, but because of active marketing of the trust and through strong performance. So that's our job. We're out there doing these kind of events and making sure that shareholders are listening to what the portfolio opportunity is. We've also been buying stock. Nick and myself put well, for us, a reasonable chunk into the shares in the last 2 or 3 weeks, and that complements what we were buying at the IPO. And I know that Nick Lewis, our chairman of Downing, would also be happy for me to say that he's also topped up his holding. He's got another £100,000 worth. So we've got a good whip. We've already recycled cash at around about 15% through COVID, and we are feeling pretty bullish about the portfolio. I will come on and answer some of the questions in a second, but I would also point out that I know that a few of you have had issues when trying to get hold of information on the trust. Everything is on the website, but here we will put Jean's name up in lights. If you are looking for any information on the trust, then please contact Jean. Her email address is there, and also her mobile number. So please feel free to inundate her. We'll make sure that your name is on our distribution list. Right, just coming to some of the questions now. Oh, sorry.
No problem. I was going to say, we did have a pre-submitted question, but just if we could address that first, then we can come on to the Q&A, because we've got some great questions that have come through. But firstly, thank you both for the very detailed presentation. As I say, ladies and gentlemen, do please continue to submit your question using the Q&A tab situated on the top right-hand corner of your screen. But while Judith and Nick just take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard on the platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for that opportunity to provide your feedback in order the team can better understand your views and expectations. Just before we do jump into the live Q&A, we did have a number of pre-submitted questions, of which you have covered off the vast majority in the presentation itself. But one perhaps I could address to you, Nick. We had a couple of questions around high inflation, low interest rates. Let me read this one out, and that sort of covers both off. How do you expect your companies and the portfolio as a whole to perform in high inflation, low interest rate environment?
Yep, thanks. I think there's a couple of aspects here. Obviously, the first is the way in which our portfolio companies will tackle higher input costs and pass these on to their customers. And so far, we haven't spoken to any management teams who are not successfully passing on most, if not all, of the costs here. And we think this is a function of buying good businesses, which are important partners in their customer supply chain. I think a good example of this is Volex. I'm sure this is an example that a lot of people think about with inflation and the DSM portfolio. But think of a few examples. If you're supplying a power cord into a consumer device, or a charger for a Tesla, or a complex assembly into a CAT scanner, the customer can't ship these items without what's quite a small and low value part in the scheme of the total sale. So the value to them, of a few percentage points on such a small input is low. So we think that Volex are being quite successful in terms of passing those costs on, and of course, that inflation is affecting all of Volex's competitors too. It's also worth noting just now, what we're seeing is that consumers are absorbing all this inflation. So it's being passed all the way down the chain. White goods and consumer goods are at least 30% more expensive, if not more, than at this time last year, and with longer lead times. So, the demand, even at these inflated levels, is still exceptionally high. I think that the second aspect is, potentially what this means for valuations and how the Bank of England might attempt to tackle inflation. But as we discussed in the slides, we do think that should place more value on near-term cash flows. These are typical of value investments and typical of the types of companies that we hold, since their cash flows will be discounted lower. So we don't tend to make super long-term, excessively discounted blue sky investments. Most of what we're investing in is based on near-dated cash flows.
Thank you very much indeed. Obviously, we've had a number of questions submitted during the meeting itself, and you may not have the opportunity to get around to all of them. But perhaps if I could just ask you just to click on that Q&A tab, and where appropriate to do so, if you could read out the question and give your responses between the two of you, that'd be fantastic. Thank you.
Yeah, if I can take two questions. We've had two questions on Techmar, which was one of the new. I think I said in the slides, we made 6 new investments this year, and we still have 5 in the portfolio. Techmar was one of those investments that we made and which we subsequently exited. And there's, I don't want to say too much, because we still get on quite well with the company, but there was just certain parts of our final stages of diligence which we didn't like, and that's not to say that Techmar is a bad is a bad business, and certainly we think that the markets they're involved in over the long term will be exceptional. But there were some exposures that we didn't want to have in the portfolio, and we decided to sell down at that point.
I think there's been another couple of questions on holdings that have gone out of the portfolio as well, and I think also one question on showing the profit or loss on some of these positions. So another one was Science and Sport, and again, not wanting to go into too much detail on it. A company that we really like the growth profile of the market, the margins, and really the overall deployment of their strategy. I think we when they did the fundraising, the COVID fundraising back in March, well, whenever it was, last year, wasn't it? And they had quite a lot of net cash sitting on the balance sheet, and we probably had we had a different view on return on invested capital, I think, to what the management had, and therefore we felt as though it was the right time for us to maybe not continue to hold that. We are, if we see things that we are maybe going contrary to our investment case, and also where we believe that management might not be quite as aligned with shareholders, then we're not scared of moving out of the positions. Nick, is there any others? There's quite a few here actually, with really good questions. Just trying to pick ones that hopefully have a bit of crossover with each other. So I think a couple of questions on Real Good Food and the remaining debt that's there. So the 20 million debt that's there is loan note holder debt. So that's not bank debt. That's a return that comes back to us. So in effect, there is a redemption premium. There's a convertible element of that debt. So we would also not be expecting just to get the return back through equity, but also through those debt instruments. And I think somebody else asked if there might be a continuation of the overall strategy on Real Good Food via divestment in the next 12 months, and I can't comment on that, I'm afraid. But clearly we're in a phase where we're keen to get a return for all stakeholders, not just loan note holders. Somebody asked, what is the exit profile for companies you invest in, and how do you purchase the positions when they're typically illiquid? Do you have to wait for a fundraiser? I think that's a very, very good point, actually. So we've always got a plan A and a plan B, because it never quite goes to plan. But the plan A is that if you can hopefully make earnings increase, hopefully double over a 3 to 5 year period, then you'll get the kind of target returns that we're looking for. Very, very simple, not quite that easy, obviously. And therefore, if you can do that and get multiple expansion at the same time, then that's a nice nirvana to be in. And you can see it with companies that do have that kind of breakthrough where you can get other investors interested and you do get earnings growth and multiple expansion. But we can't bet on the market valuing everything in the same way that we do. And therefore, we do have to have the plan B, or sometimes it's actually the plan A, where we're expecting that trade activity and M&A activity will take place in some of these sectors. And I do think, you know, there are a number of unloved little companies that are actually doing pretty well, that we know are likely to be taken out by either private equity or trade. And it's always good to have management teams that are thinking in the same way and aren't just looking for a job for life. Liquidity on the way in, it's sometimes it's to do with a deal, an acquisition that we might have been helping work the company with, and therefore we're at the pole position when it comes to doing a fundraise. And other times we can actually just seek out liquidity in the market. We do all our own trading really, with the help and advice of a third party, but you do really need to work to find pockets of liquidity, both in the way in and the way out. So it's we're not always just looking for that event when it comes to a fundraise. And just on that liquidity, somebody else has asked, do you have any liquidity requirements when looking at investing in new companies? Yes is obviously the answer to that. What I would say is that we are clearly looking at liquidity and shareholder lists all the time when we're about to make an investment, but we're also looking at the daily flows. But the investment trust, we do have a benefit of having the investment trust. It's not an open-ended vehicle. We don't have constraints on our own liquidity, but we do want to make sure that the shares do trade a little bit. If it's highly illiquid, which is a bit like real good, that we can get trade exits or private equity involved. Nick, any other questions you want to take?
There's one to do with taxes and the difficulty on chips to do with the shortage that we know is going on just now. I think what we alluded to or what Judith alluded to when she was speaking was tax's ability to navigate these quite complex supply chains within China, the ability to design and spec hardware with the customer and to get it to market. And the key there is that they're not limited to any certain one chip for any one notebook, for example. So they can go, if there's a shortage in chip A, then they can source and spec in chip B, and we think that that's one of the nice things about the flexibility of that model. And just quickly, I spoke to management last week. They actually didn't say they have any issues just now in terms of the supply side. They are seeing some shortages in terms of panels, but it's not something that is causing any kind of delay to their shipments just now.
Judith, Nick, I think you've pretty much covered off all those questions you can from investors. And of course, if there are any further questions that come through, the company will be reviewing those on the platform. Judith, perhaps I could just ask you for a few final words just to wrap up, please, if that's possible.
Indeed. Well, thank you very much for joining and listening to what's been happening with the portfolio. Hopefully, we've given you a good flavour of some of those older investments, only 4-year-old, but older investments that we made at the start, and where we've hopefully demonstrated where those catalysts are beginning to play out, and given you a bit of background on the newer investments within the portfolio. We certainly feel, as you can tell from our own share buying, that we are at quite an interesting point in the life of the trust. We talk about a 3 to 7 year investment horizon, and we're about 4 years into that, and one of them was a COVID year. So we probably would have been liking to do some of the initiatives this time last year, but we certainly feel that we're firmly on track to continue delivering the performance that you've now started to see over the last 3 to 6 months. Thank you very much.
That's fantastic. Judith, Nick, thank you again for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments for you to complete, and it's greatly valued by the company. On behalf of the management team of Strategic Microcap Investment Trust PLC, we'd like to thank you for attending today's presentation. That concludes the session. Thank you and good morning.